discussion called Leveraging Advanced Machine Learning Processes to Extract Valuable Insight and Increased ROI. We're going to talk about rationalizing the resource spend of advanced machine learning practices. We're going to talk about reinforcement learning and whether this is really adding value and how we might utilize its potential. And we're also going to talk a bit here about leveraging an NLP and sentiment analysis for better investment decisions. And I'm sure here with this really distinguished panel, we'll get into many other interesting and tangential topics. So let me start off by introducing to you the panel we have here with us. We have Simon Chao from Fidelity Investments. We have Giuseppe Nuti from UBS and Andrea Nardon from Black Alpha Capital. I want to highlight that towards the end, maybe the last 10 or 15 minutes or so, we'll open it up to questions from the attendees. So please feel free to post any questions that you have to the chat. But now I want to turn to the panelists and have each one of them introduce themselves a little bit more and maybe provide a bit of a background about yourself and specifically talk a bit about your current role, your function, and the kinds of things that you are currently working on. Maybe Simon, you can get started.
Sure. Thank you, Petter. Hello, everyone. My name is Simon Chao. I am the head of emerging technology and asset management at Fidelity Investments. We are one of the largest asset managers in the US. At last count, I think we had just over $4 trillion in discretionary assets, just to give you a sense of our size. I've been with the firm for about 17 years. And again, I lead the emerging technology team, and we are a collection of data scientists and full stack engineers who apply AI and machine learning towards investment use cases with three primary objectives: increase alpha, improve productivity, and reduce risk. Thank you. Happy to be on this panel.
Thank you very much for that, Simon. And you, Giuseppe?
Yeah, thank you, Petter, and thank you for inviting me on this panel. Pretty exciting. So I'm Giuseppe Nuti. I work at UBS. I work on the research quant team. We're really focused on, I guess, applying ML techniques to some of the problems that I think we've had for many decades. I would say, really, I would say the focus or the book of work is split into two areas. One is mainly centered around algorithmic trading, and this spans agency execution. So for our clients, like Fidelity, for example, or you know, on the principal side, on the market making side. The other sort of growing book of work is more centered around affinity models and taste algorithms. I think that's something that's becoming more and more popular in the banking world as well. Maybe started with Netflix and all that, but still we see a lot of that and looking at modeling client behavior, making sure that our services are targeted to the right clients, etc. And it's certainly quite an interesting area of growth.
Thank you, Giuseppe. And Andrea, how about you?
Hi, hello everyone. My name is Andrea Nardon. Thank you so much for having me on this panel. Very much looking forward to chat to you about ML and the various applications. I'm Chief Quant Officer for Black Alpha Capital. It's a quant hedge fund headquartered in London. My main role is really to further develop the investment strategy we have, which is pretty much entirely ML driven. So my application, which reflects in a way my 20 years of experience in the applied quant research space, is how to use and how to deploy machine learning tools to try to improve the profitability and the risk profile of the investment strategy.
Thank you very much. And my name is Petter Kolm. I'm a professor at NYU Courant, where I've been now for the last 14 years. Besides doing what professors do, which is to teach hungry and eager students quantitative finance and financial machine learning, I also work very closely with industry, sitting on several corporate advisory boards, including that of Betterment, AltEG, and also the Swiss fintech company called ISOT. We deal with a lot of questions involving buy-side related investments and cutting-edge machine learning type of approaches. I want to start off this conversation here with this panel to hear a little bit about some of the recent use cases that you have been involved in that leverages machine learning processes to extract valuable insight. Maybe Andrea, maybe you can start.
Yeah, with pleasure. So we've been using quite a variety of machine learning tools, particularly in the supervised and unsupervised learning. Reinforcement learning, which I think is going to be a topic for this panel, I'm very happy to chip in later on, but that's an area where I would say we have less experience with. It's certainly the most fascinating one, but there is some complexity related with the application of these models to real cases. When it comes to what we do, we really try to take pretty much very simple old statistical models, what we used to build 10, 15 years ago, with a very simple logic, and simple logic based on inputs and signals that we believe have predictive power. Predictive power, not necessarily in the sense of being able to predict tomorrow's return or next month's returns, but signals that are able to generate profitable trading situations. And then with the use of more sophisticated tools, like the one that you have in unsupervised learning, with clustering or with decision trees, for instance, within supervised learning, we try to kind of improve the results of those original models. And I personally find the power that these models have, it's quite amazing, but they come with a lot of issues. So if you apply those models in the wrong way, you ended up having overfitted kind of situations that will not really produce good returns going forward. So I think while these models allow you to extract additional information from the signals that we've been using, because it's not that you can reinvent signals every year, so you can extract a better information. At the same time, you need to be incredibly careful in managing the complexity around it, because once we all agree the fact that using non-parametric methods is great, compared to the past, but the reality is that complexity is still a variable that you need to control. And if you let these models explode in size, well, they will just memorize input-output relationships rather than learning anything from data sets. So so I would say we have quite a deep experience in supervised and unsupervised learning, not so much within the neural networks, which despite I've been using them since university, so a long time ago, I still find them quite challenging to use. But on the other camp, let's say we have quite a few models that are running.
Thank you very much for that. And Simon, why don't you tell us a little bit about your recent experience and some use cases?
Sure. I could talk about one which is top of mind, and that's related to ESG. For those of you that are unfamiliar, ESG stands for environmental, social, and governance, and they represent 3 pillars through which companies are evaluated. So traditionally, if you think about either a quant shop or a fundamental research shop, they have analysts that rate or score companies. It might be a strong buy or a strong sell, et cetera. So ESG is a different framework for evaluating these companies. And as the name kind of alludes to, environmental, if there's a company that is dumping toxic oil into the ground or into the oceans, then that's going to score very low on the E pillar. Social, think about non-diverse boards, right? You might have boards that are comprised solely of wealthy, older white men. And then governance is something that's kind of been around for a while. You don't want board members or C-suite officers that are giving favors to relatives, et cetera, or even doing something that they shouldn't be from a regulatory perspective. So this is a new framework, or rather I should say, it is really picking up steam. These days you can't even read an article in the finance world without hearing something about ESG. So what's interesting with ESG is that there are a lot of there's a lot of literature out there with respect to these companies, and there are a lot of companies. However, there's not a great way of understanding the data underneath the scores that current vendors are selling around ESG. So the big 800-pound gorilla that's selling ESG scores today is MSCI. Another one is Sustainalytics. They were recently purchased by Morningstar, and they sell ratings. So a company might have a AAA rating for ESG. However, it's relatively stale. I think that if you look at their website, they'll tell you, that they update them perhaps once a year based on annual reports. It's opaque. They don't tell you how they arrive at their scores. And so what we are able to do through machine learning, natural language processing in particular, is we actually can go out to each of those company websites, download the documents. So the corporate sustainability reports, diversity and inclusion reports, or any just HTML on their website that is pertinent to ESG. We take that, bring it in-house, and we can run it through a number of different language models and classifiers to identify this is something that can give us some insight as to how better to score a company based on an ESG rating. And that's something that we think would give us an advantage over our competitors, over our peers, in terms of having a much more accurate and timely evaluation of companies with respect to ESG. And that in turn is going to have an impact on our bottom line, because again, if you think about the millennial generation, this is all a very activist sort of generation, and a lot of flows are going into ESG highly rated companies.
Great, thank you for that. And Giuseppe, how about you and your team at UBS?
Sure. I mean, I think obviously there's quite a bit to choose from, so it's hard to pinpoint, but maybe one of the ones that I thought would be interesting to the audience is really centered around agency trading, and I guess, our equity execution and how we execute, either for our own book, but more often for our clients. And this is, I think, interesting, mainly maybe because historically I have not been focused on the equity market. I'm more like a sort of fixed income FX guy. And in two years or so ago, I moved into looking into equities. And what amazed me is the number of choices that you have. It's, sort of other markets tend to be a little simpler than the rather more mature, especially in the US. And you have 40 dark venues, 15 lit venues, many different order types. And so, the question we were asking ourselves, how do we optimize all of these levers? Like, where do we send an order? What peg do we use if it's a peg? What limit price? How does it impact the parent order? This is a fairly noisy process. We have the action set is very large. And you can look at it historically, I would say, most firms, and I mean, I'd be curious to hear the audience's view, but most firms have developed this stuff, sort of almost organically, like a new venue comes in, well, we'll slot it in this particular point. And then, the next venue comes in, or the next order type, or, and there's some really funky things coming out now, like IEX, D-limits, whatever. So, it's something that I felt like, we should really be able we can leverage some of the more modern machine learning techniques. And of course, this has come up plenty in the academic literature. Maybe the thing that springs to mind is reinforcement learning. It's kind of like, states, transitions, that was the value of each action in a particular state, and each action can be a different exchange or a different order type, and so on. We did spend quite a bit of time researching it in the end. So maybe to echo a little bit what Andrea was saying, possibly because it's a highly stochastic environment, we were finding that, especially for the continuous variables, it was really unable to unlearn something that was not really statistically significant, but just so happened that, we had taken early on a course in that direction. So we sort of changed tack a little bit, not hugely, and opted for something more like a sort of contextual multi-arm bandit, which I guess is the predecessor or is the single state reinforcement learning approach. And here we use in terms of the context, we leverage Bayesian decision trees to basically probabilistically address what do we think is going to come out of the action that we're about to take. And I think certainly this, led us to learn a few interesting lessons, I suppose. Firstly, I would say, and this is a lesson that I tend to be relearning almost at every exercise, the noise level in financial data, and especially in trading data, is very high. So you kind of need a way to manage that noise. And of course, there are plenty of regularization techniques out there. But from an academic standpoint, they tend to stem from other industries. And I think you need to, sort of apply due care and diligence when, and again, maybe to echo the other two panelists, like neural networks, yes, you can take them out of the box, but, do so with care when it comes to financial data. But the other lesson, which I think was very interesting, is also about, explicitly or proactively really managing exploration versus exploitation. One of the things that we clearly know is that we don't know everything, and we also know, as we heard from Prado earlier on, in an earlier panel, we know that it's non-stationary. Like the process, we would fool ourselves to think that the same market participants are going to be there all the time. So we really want to have something that is, really proactively exploring the space where we can manage that exploration. Of course, we want to exploit, we want to execute optimally. Simon, Andrea, they expect us to execute optimally, but we also have to explore the right amount, because we know that we can't be optimal all the time without that exploration. And I think that's been certainly a very interesting lesson learned.
Great, thank you. A couple of follow-up questions here to you. So I'm curious, the choice of deploying the multi-arm contextual bandits was that driven by the fact of that's too expensive to train more sophisticated and full-fledged reinforcement learning type of models, or is it because of the noise issue, or both? So that's question one. Question two, follow-up question to this would be, how did you decide to set on very specific models? What internal conversations do you have, or what are the decisions that you're making to decide on a specific modeling framework, or do you explore many?
Sure, those are great questions, and I mean, I certainly love the rest of the panel's opinion. But I mean, on the first one, I mean, I would say the first caveat is that whilst we explored it, our exploration was not exhaustive by any stretch of the imagination. And I am sure that given enough data, or maybe a more parsimonious modeling approach, reinforcement learning would also work. The sort of, transforming the data so that you can really, I guess, fuse more data points with, it's a trick that we often use, and maybe we didn't squeeze that one enough. Our, I guess, analysis is this. Well, the first is rather a practical consideration of the query time. In practice, for deep reinforcement learning, where you have to have a deep neural network that assesses the value of an action in continuous space, that query time, in the US equity market, we measure things at the micro nanosecond, really. Like, I mean, basically, the dev guys that we work with, they're pretty adamant. If this takes more than 2 micros to query, to find out what the optimal action is, you kind of overshot it. And, even a, GPU style, deep neural network is going to struggle to just do the query, not the training, with that kind of speed. So in practice, we're limited to reasonably simple models. I think, beyond that, though, it really is a case that, in reinforcement learning, the path of learning matters a lot when it's a highly stochastic environment. So just to give you an idea, Simon sends us an order, not Simon himself, but Simon's company sends us an order. It's just so happens to be a stock. They're buying a stock that, they've done great research, new NLP, it's all there, and it's going up whilst they're buying. This is going to look very bad as a routing decision, but it's not necessarily bad because we chose the wrong exchange. It's just so bad. It's just bad because the market was going up, at the same time as we were buying. And that is going to be very hard for reinforcement learning to unlearn, even if you fiddle around. And by fiddling, I say fiddle with a capital F, with the learning rate, even the sort of the newer paradigms there, we struggled, put it this way. Not to say it wouldn't work, but we certainly struggled. The second, well, and obviously here I would mention something that it's also dear and probably connected to your second question. And the other part is sort of somewhat explainability. We, whilst in this case, explainability is not a prerequisite, it's certainly desirable. We want to be able to say to our clients, but also to our auditors, regulators, and so on, we took this routing decision because, historically, when we see high volatility and the order book is highly imbalanced, we see inverted venues as with a higher likelihood of fill as being beneficial. We need to be able to make those statements reasonably clearly, and again, that sort of precludes a whole lot of techniques. Now, in terms of the selection of model, I've increasingly come of the opinion that without wanting to sound too absolute, that the data is what counts. In the end, if you have clean and, as Andrea said, predictive data, does it really matter a huge amount where you use a neural network or a thing? Like, generally speaking, once you have very valuable data, the rest, it kind of works by itself. That said, we certainly like to explore certainly a couple of contender models. I mean, we're mandated to do so anyway from our model risk chaps. But in the end, we're not going to see a huge delta. Once you have a reasonably tidy input data set, we're not going to see a huge delta between the models, or at least we shouldn't.
Great. Yeah, thank you for that. Andrea, I wanted to ask you, you spoke a bit about how you leveraged decision trees in the investment process. Maybe you can shed some more light of how you deployed them, and to the extent that you can speak about it, whether this is for long or short-term signals. Experience there.
Yeah, absolutely. So, well, I've been working with decision trees for quite some time. So I've been using them extensively over time, and the lesson that I learned is that whenever you are unable to keep the complexity of the tree under control, like Giuseppe said, actually, I would be even stronger. I would say that being able to explain what the model does must be a requisite, because if I'm going to put monies of clients at work, with a model that I built, I need to be able to explain them at any point in time why we took that decision and why the model reacted in that particular way. Now, the difference between the application of Giuseppe's work and mine is that he's focusing on the ultra short term, and therefore he's after an information that needs to be very, very fast, that needs to be able to guide him to execute in a certain place rather than another. In my case, my sort of long-term track record is more to build investment solution for institutional clients like pension funds, sovereign wealth funds, where the signals that typically I've been using are relatively low frequency, very low frequency, i.e., monthly rebalancing, quarterly rebalancing is typically what you do. And I think possibly there is a bit of catch up in terms of knowledge that needs to happen. It is very true that the larger the investor is, there are concerns around the cost of execution, not just the fees that you pay to the UBS of this world, but the real cost of having your order worked in the market. But it's also true that if you are not able to rebalance your portfolio more frequently, our research has shown that the less you rebalance, the bigger the drawdowns that you need to be able to accept in your strategy, and which is quite intuitive, really. I mean, it's not that it needs to be proven mathematically, but if you may be right in having a long-term prediction of where assets are going to go, but you may be stuck in a short-term correction in the market. Look at what happened last year, for instance, with the pandemic. It was a great year for equity, although you had to swallow a very big drawdown. So I think, you need to capture all that. Now, with regards to your question, how can you apply decision trees, for instance, or clustering models to this data? I don't think that the type of signal you're using will influence the choice of one model rather than the other. So answering your second question that you asked, Giuseppe, is I would say that I really don't mind what the model is, provided the outcome is really good. Therefore, I carry on researching and switching from one model to the other until I find the result that I want. And the result is then measured in terms of consistency, of the performance of the strategy over time. So I'm not necessarily looking at the best return or the best risk-adjusted return. I'm looking at consistency. But yeah, specifically, I can enter in more details if you allow me another minute, maybe. I spent a lot of time looking at converting long-short signals for a long-short equity book that I was running in my previous employment into more of an asset allocation framework. And I've discovered that actually decision trees, like clustering models for that matter, allow you to take a completely different view on how to construct optimal portfolios. And I came to the conclusion, which is very harsh in a way, but you know, I grew up culturally thinking always in terms of an optimal portfolio. And an optimal portfolio, I came to this conclusion, it may exist only if you accept modern portfolio theory as the theoretical framework. And I discovered that using these tools, if you think out of the box, you're basically able to construct portfolios that are, by all means, not optimal from a mean variance point of view, or you know, an evolution of the mean variance approach, but their profitability and their performance is superior. And there it does take a touch of imagination. You know, you need to have an intuition on how to use signals that you gather from the market in a smarter way, and then using these models to come up with, you know, to come up to an optimal portfolio allocation. So I think that yeah, you need to continuously research on signals that match your investment horizon, and then you need to go through model by model and see which model is really able to give you the outcome that you want to have.
Right. And Simon, you guys have developed a really nice NLP infrastructure. I'd like to ask a few more questions about that, if I may. Maybe we can talk a little bit more about the kinds of NLP approaches that you guys have explored. People often start off, you know, when they start dipping their toes into the space, they start off with relatively simple bag of word type of approaches, TF-IDF, right, moving to topic models, and then maybe using later on more sophisticated transformer models such as BERT and FinBERT. Maybe you can elaborate a bit on that, and you know, what models you have explored, and you know, which ones work, and perhaps why.
So we've actually used all of those. We've used bag of words, we've used word to vec, we've used BERT, we've used FinBERT. And I'll kind of go back to what Giuseppe originally mentioned. It's really about the data, right? I can't really say categorically that one model is better than others for a variety of reasons. Based on the data, sometimes one model might perform better than another. You might have constraints around explainability. And sometimes those constraints might actually be weighed more heavily than accuracy, right? Especially if you're in a heavily regulated environment like in the financial world. But there exist tons of turnkey solutions out there as well. I think with the rise of alternative data, AI is sort of like, you know, sort of again, back in the public mind. Tons and tons of startups are coming out, and they offer a lot of no code or low code solutions. Personally speaking, this is Simon's opinion, not Fidelity's. I tend to be wary of those. There's this notion of a citizen data scientist, which essentially is a person who is knowledgeable enough about data science just to be dangerous, but they weren't classically trained. They're not familiar with sort of like the way of truly analyzing the data in a scientific way. And there's some pros and cons to that. On the one hand, data scientists are, you know, they're fairly sought after in today's job market, highly trained, highly skilled, and it'd be nice if other associates within a firm would have access to this capability and skill. But I kind of liken it to giving a scalpel to someone who isn't a surgeon, right? They can do a lot of damage with it if they don't know what they're doing. And so I think with respect to NLP, it's fairly straightforward and simple. I mean, I don't know if I would necessarily call it a framework. There are tons of open source libraries that we use, some of the algorithms that I had earlier referenced, but it basically comes down to 4 steps. You collect your unstructured data and centralize it. You clean it up, whether removing stop words, stemming it, lemmatizing it, and then you choose a numerical representation of that text. So in certain cases, we found that BERT has been fantastic with this. So for those of you that don't know, BERT is a language model that was invented by Google maybe 3 years ago now. I'm kind of a little hazy since the pandemic has kind of thrown my timing all off. But they've done an excellent job in terms of converting unstructured text into numerical vectors that actually capture the semantic meaning of what that text is. And then we use that to classify. So you can imagine if there's, two different paragraphs of text that use different words but have the same meaning, then that vectorized representation of the text will be very similar. And you can perform, there's numerous distance approaches you can use, but we typically use cosine similarity. And the closer that the value is or the difference is to 0, that means the more similar those pieces of text are. And so that's the approach that we use, and it's very generally and broadly applicable. This does also, however, rely on having access to labeled data. So for ESG, in the prior example, it relies on our ESG analysts kind of going through various websites, looking at certain reports and annotating or labeling the areas of text that are relevant to a particular ESG factor that they're interested in. So an example might be, does this company have a chief diversity officer? Do they offer unbiased or rather unconscious bias training? And all the different myriad of ways that that can be articulated in written text, it makes it very difficult. It's not as simple as just doing like a word search or writing a program where the exact logic, like a direct string compare. So that's an area where machine learning and NLP really excel in sort of like having those softer edges to play around with, where you're not dealing with hard thresholds or parameters. That's Peter, you mentioned that this might go off on a tangent, but Giuseppe, you had mentioned about some of the potential costs in terms of if you really, working with complex, many-layered neural networks and even just the query time. So that's an area where I think it really helps to leverage the cloud. So these days, having access to cloud, not just for storage, but also for compute, where you can rapidly scale up and scale down based on what you need, I think is one of the reasons why AI and machine learning have really jumped into the mainstream these days. It's really been a huge enabler.
So when it comes to these more sophisticated transformer models, right, at least the original BERT model, when it came out as a pre-trained model, several hundreds of layers. Do you use it out of the box, or do you retrain this model, or do you retrain just the final layers, the classification layer, or how do you approach this in-house?
So we use it as a starting point. And again, there's no, I would say in some cases, it's more of an art than a science, right? It depends on the outcome that you're seeking to achieve, as Andrea had mentioned. We don't want to prescriptively say this BERT is the best thing. In some cases, if you look at a more tailored language model like FinBERT, which was trained on a corpus of financial documents, that might yield a better result that you're looking for. If the problem set that you have in front of you is more Wikipedia-like language that the original BERT was trained on, then that might yield a better outcome.
Understood. Yeah, and that makes a lot of sense. I wanted to come back to you, Andrea. You were talking a bit about Drawdown and managing Drawdown, and I'm curious whether you have explored any machine learning techniques there for the management of Drawdown. What can you share with us?
Well, it's a very complex topic in the sense that I will not answer is saying, well, machine learning techniques allow you to achieve a lower drawdown in your investment process, because we would undermine effectively the rest that's been working well or very well in many cases. I think that the advantage of machine learning tools compared to conventional statistical techniques is related to the type of signals and inputs that you're using. So if you're using, for instance, and I talk about a concrete example, you're looking at a multi-asset portfolio invested in a variety of asset classes. Think about equities, bonds, commodities, alternatives, equity volatility protection, and so on and so on. And you have the ability to, for instance, use among your various inputs predictive measure of risk, an indicator, a tangible measure that tells you how much risk there is in the system, for instance, today. Using machine learning tools, you're able to sample from the past the relevant information. And so provided that the quality of your inputs have got predictive power, they're able to tell you, for instance, we are heading towards a very nasty time. So again, let's look at what happened last year. I think it was the end of February when the market started hitting down. You know, if you were able to translate that situation that we were witnessing in those days at the end of February into your model, the model should have reacted and should have told you, you know, move on a risk-off environment, i.e. start decreasing leverage, start taking money off the table from risky assets, start parking it in protections, volatility protection, gold, for instance, short-term treasuries, things that actually moved out quite rapidly. Unlike risk parity models, which literature has dedicated, you know, a ginormous amount of time investigating all these various forms of risk parity models, which actually all fail, but they all fail for the same reason, because computationally, you know, they rely on a time window. And so if you have a couple of weeks of a sharp drawdown, you know, that may not be sufficient. That may not be enough to trigger a switch towards less risky assets. So concluding, I think that if you want to achieve a low drawdown in your investment process, you need to have the ability to rebalance your portfolio very frequently. And by frequently, I don't mean intraday. I mean on a daily you know, you need to be able to reassess the situation on a daily basis, which may not necessarily mean that you need to trade every day, but you need to be able to have the chance to trade in case it's needed. Two, you need to have a set of inputs that enable you to assess the situation from a risk perspective, not looking at historical measures of risk, but predictive measures of risk. For instance, looking at the VIX index, that's an example, or looking at implied volatility derived from the option contract, you know, which is something that hasn't been really explored extensively by academics. Collecting the data is difficult, cleaning the data is tough. You know, you have data only on liquid assets and not illiquid assets. So there's a reason for it, and I perfectly see the case. And three, you need to have a set of tools, which obviously decision trees, clustering models are designed for it, that should be able to tell you, you know, you're heading towards, you know, it's not even you're heading towards a difficult time. It is a difficult time. You should take money off the table. And if you do that, you will see that, you know, the drawdown profile will substantially improve in line with the volatility profile of the program, enhancing, therefore, the Sharpe ratio. So our research has shown us that it's not even the return that you can improve by trading more frequently, but it's the volatility profile. So if you are an investor that cares about the Sharpe ratio, the risk-adjusted returns of a program, then those are the conditions that you need to try to exploit. So
Great. Yeah, no, great. So I want to shift gears a little bit, keeping an eye here on time. I want to take some of the attendee questions. So if you have yet not asked your question, now is the time to post that into the chat. Here's one that I think is quite an important one, and that is that's to all of you here to respond to, perhaps. So how do you handle keeping real-time model decisions clear and plain English to people like executives and fund holders, right? How do you explain to them? How do you get buy-in? Maybe Giuseppe, do you want to take a first stab at that question?
Sure. I mean, give me the tough question. I like it better.
Yes, yes.
No, look, I mean, so I would say it depends on how, one has approached the problem. I think for certainly some of the things that some of the techniques that we've discussed here centered around trees, with the exclusion, obviously, of multi-tree like random forest and XGBoost. But on the single tree approach, the decision is in plain English. When this interval is within this, this input is within this interval, and this other input is within this other interval, this is the experience that we have. Now we can argue how we came to that interval or those intervals in the, sort of in the hypercube of the input space, but it's as plain English as it comes. I would say that the full explainability probably stops there. Anything beyond that, whether it is, as I said, like, a more forest or large number of trees or neural networks, LSTM, all that kind of stuff, like there isn't really an equivalent, at least not that I know of. So there's a number of packages, of course, that help you explain. Most of them are gradient based, and I'm sure here, there's much better experts than I am. There's local explanations, global, there's sort of models that, are built on models. I think here you kind of get into the realm of, sort of the who's asking the question and to what level do we want, that question answered. But, the sort of the maybe forgotten aspect or less worked on aspect is what are the controls around your algorithm? Because in essence, if the data that you're using is publicly available data and your expression of the algorithm is, properly vetted and cannot, disrupt the market, takes appropriate risk through an independent risk control, like, yes, you might want to explain it, but maybe the onus there is not so much on explainability. Conversely, I think when you're using private data, especially customer data, or when your potential impact on the market, on the fund or whatever could be significant, there maybe explainability may be more desirable. I don't know, I guess Andrea, Simon, you guys have plenty of experience in answering this question as well, right?
Yeah, I was going to ask Simon, what about you? What's the situation for you guys? What demands on explainability do you have? What's asked from quote unquote upper management in
Sure.
terms of that?
So, I mean, yeah, I think it's very important to understand your audience and their level of sort of like technical knowledge. But ultimately, I think communication is a skill, and it's all about making the content relatable to the folks that you want to communicate with. So there are certain tricks to doing this. As Giuseppe mentioned, for decision trees or even random forests, it's fairly straightforward. Sometimes you can use tricks like PCA or principal component analysis, dimension reduction, to try to simplify things a little bit. And perhaps if you can convey that the output of a particular model is based on, it's like an equation, like a mathematical equation, and this equation has multiple terms, and each of those terms have coefficients, and that the larger the coefficient, the more heavily weighted a particular feature is on the ultimate output of a model. So, I mean, that's sort of the approach that I would take in general.
Great. And Andrea, here's kind of a follow-up question. And I think someone here asked it now just from the audience, at what level of superior performance does explainability no longer matter to an investor? If you're able to create a black box model that is just so great, at what point don't people care about explainability, or is that just a nuisance?
No, and that won't be me managing those strategies, because if I can't explain what I do, and if I don't understand what I do, I will never be sitting there, to be honest. So I wish them good luck, whoever does it. I think it's a beautiful question. It's a beautifully formulated question, but I'm afraid I don't think there'll ever be someone out there willing to accept uncertainty or buy into a black box, not knowing what's going to happen.
Great.
I mean, maybe
I think if I can add one thing to the previous question, which I think Simon and Giuseppe answered beautifully. So the only element that I'd like to add, which is more philosophical in a way, it's like the financial sector has actually had a very, very slow progress over the years compared to other industries. The penetration of technology, of automation is very limited. Now, take away maybe the investment banks where we're, from an execution point of view, we've seen a lot of technology deployed, but the buy side is actually didn't have that progress. And I think you should expect today from the executive world, more knowledge on how things are done. The fact that, I don't expect a CEO to understand perfectly what the investment engine looks like, but they should be familiar with it. And the reason is very simple, because they will be using a smartphones, which is packed with plenty of technology that is classifying the pictures of friends and families. They're classifying, they're coming up with music that is similar to the music they like, or films proposition, which is precisely what we do in finance. But it's interesting that I see a lot of people using that technology in the day-to-day world, and then when they come to the office, if they say, "Oh, I don't understand this," I can't buy into that. But I find it interesting. It's.
That's great. Yeah, we just have a couple of minutes left, and I wanted to kind of just get a sense from each one of you, maybe a minute each or so. What are some of the new machine learning techniques out there that makes you excited, and that you're thinking about? Yeah, maybe this is something one should look into, or you're curious about to explore. What's on your mind in that regard, Simon?
Well, one thing that has been getting a lot of news time is autonomous driving. So it deals a lot with object detection, like real-time object detection, obviously. And I think that that's a very exciting space to enter into, because I think that'll transform numerous industries.
And what finance applications do you see of that? Do you see any finance applications there from autonomous driving?
Well, not autonomous driving per se, but we have leveraged object detection in some OCR, so object character recognition applications. One example that I can share is in our compliance space, right? So if you think about fund managers, they need to submit like these massive orders, and there's all these compliance rules that they need to satisfy before an order is allowed to go through. How do you ensure that the compliance rules are all captured from fund prospectuses, and is it going through the right engine? Are these rules being duplicated? So one way of doing that is by looking at, again, these documents, and they might contain tables in there. Tables traditionally have been pretty difficult to extract information from. I mean, you have Amazon Textract, you have a few others, but they're not perfect, especially in more complicated tables where you have columns that span, or column headers that span multiple columns, you have pagination breaks, etc. So using object detection coupled with more traditional text extraction is an area that I think is pretty exciting. I think that it has a lot of value.
That's great. And Giuseppe, what about you? What is it that keeps you up at night and that you think about finding it exciting?
Yeah, I mean, apart from a bit of jet lag, what keeps me up at night is, I guess there's so much interesting research done. I mean, to be fair, Peter, we spoke about earlier on some of the work that you've done on sort of order book data and using, deep neural network, and specifically LSTM. I think, where there's a lot of data, I think, that kind of area of research is super interesting, and it's going to continue to grow, I would imagine. And, certainly I thoroughly enjoyed reading that. I mean, otherwise, in terms of, I think interesting, I've been spending a little bit of time looking at implicit fields, which I think is quite an interesting take on neural networks, and sort of the idea that you train a neural network to to find the parameters of a function, as opposed to, sort of the output in its raw format. This really is born out of a vision where, representing objects, in the visual context, via pixels is a highly inefficient approach, and totally unexplainable, whilst implicit fields are by definition. So I think that's quite an interesting area that I think could find some interesting applications in finance, probably because of its natural regularization approach. And then somewhat unconnected to what we would consider normally machine learning, but an area that certainly I've been doing a lot of reading in is differential privacy. I can't help but feel that, whether it's in our industry, but also in the traditional West Coast industries, the idea of using the data for the benefit of the providers of the data, something that I guess in the medical industry has been around for many years, but no other industry seems to take it as importantly as they do, and I think that area is going to be certainly an area that we will all be focusing on a lot more going forward.
Yeah, well, that's super interesting. Andrea, you get the last word here.
Nothing very exciting. I think Giuseppe's got very sleepless nights thinking about this very complicated stuff. No, I'm much more down to basic. I think reinforcement learning is an area that requires. I would love to spend more time doing research, and like Simon did, I think NLP has got a great potential, particularly to harvest. Not necessarily ESG, which I see perfectly why it makes sense, but for instance, rediscussing the value signal. Value investing is something that's been proposed for many decades. It's struggled a lot, very much. When you look at indices out there that try to harvest value, they've all been struggling, and possibly because the simplicity on how those are, their construction is very simple. Potentially they've been failing there. So using NLP to try to identify value, potentially with some quality as well, I think that would be that's really fascinating. Yeah,
that's wonderful. Yeah, I want to thank all of you, Simon Chao, Giuseppe Nuti, and Andrea Nardon, for joining us for this panel discussion on leveraging advanced machine learning processes to extract valuable insight and increased ROI. Well, since we have been spending here the last 52 or so, 54 minutes now, all of us need to go back and produce some ROI. So I want to thank you, and I want to thank the attendees for this interesting conversation to be continued. Thank you again.
Thank you, Peter. Thank you.
Pleasure.
Thank you.
Thanks.